Hello everybody, this is Greg Gossett from Gossett Trading and Mentoring, and today is Saturday, August 30th, 2025. How you doing? I hope you're doing well. I hope you had a good trading week last week. I hope you are enjoying your long weekend. It's going to be a long weekend because of Labor Day, and I really appreciate you coming to my weekend review podcast. I hope you're going to find it helpful. I think I have some good things to share and to teach this week. So we'll just get right into it. So the format for today is, first of all, we are going to run the U.S. legal disclaimer. Excuse me. Secondly, we're going to come back. We're going to look at all the trades that I entered, exited, or that I am still in from last week. We're going to talk about when I entered the trade, why I entered the trade, what the setup was, what the signals were, how I position size for the current volatility of the market and the amount of money in my trading account. We're going to talk about where I place my end of bar stops, where I place my emergency stops, where I place my trailing stop level, how I take partial profits if the trade starts to move my way, and then ultimately how I am going to exit the position. I have a lot of positions. It was a really good trading week for me last week, which I'm always grateful for. And entered some new positions, exited some positions. But what you're going to find here is that when I am in a trade that is working for me, I stay in it. When I'm in a trade that doesn't work for me, I get out very quickly, right? So I'm very impatient with my trade, with my losers, and I'm very patient with my winners. So we'll go through all the trades, take a look at them, see how we're doing. And then after that, we are going to talk a little bit about trader psychology. Trader psychology is the most important skill in trading. It's just essentially being able to create a process and then how to follow that process. It's all that matters, folks. Really, it's all that matters. There are a lot of different trading approaches out there. You have to find one that fits your personality. And then when you do, the most important thing is you have to follow it. That's really, I've been trading for over 30 years. And if you're just randomly getting in, getting out, trading on news, it's going to be a rocky road for you, right? In my experience, it's just better being patient, waiting for the trade. Once you get in the trade, having a plan, and then simply following that plan. It doesn't sound that hard, but it is very hard for a lot of traders. And if they were able to follow that plan, they would have done much, much better over the years. So we'll talk about trader psychology. I hope that's going to be helpful for you. And then after that, last night, Friday night, I always go down through my master watch list. I go down through it with on the daily time frame and also the weekly time frame, and I look for different, or I look for setups for the coming week that are not there yet, because if they were there already, I probably would have already entered the trade, but are getting close to a legitimate setup. And if you can do this, I mean, I have found for me it works very, 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 very well, and that's why I do it, and that's why I share it with you. But just in general, if you can look at your list of potential stocks and you can narrow it down to, you know what, this stock here, XYZ stock here, if it comes down 2% or 3% or 4%, it would run into this, that, and the other. This kind of support. Maybe it's an order block. Maybe it's an under 30, over 30 RSI. Maybe it's a major moving average, right? Or ideally, maybe it's all of them together. Well, mark that down. Follow that stock, that stock. If it gets down to where all these things converge together, that's probably a good place to take the trade. It doesn't mean it's going to be a positive trade by any means, but it dramatically increases your chance that it will. And that's really all we can do is stack the odds in our favor. So I'll share with you what I've come up with, what I'm looking for next week. And so I hope that's going to be helpful for you, just to see how I trade, see how I manage trades, see how I look for new trades. And that's the plan for the podcast. So if you find something in the podcast today that's helpful or valuable, I really would appreciate it if you could hit the thumbs up button. It really helps to keep the channel around, lets YouTube know that there's some valuable content here. And so a like would just be fantastic. And if you're not subscribed, if you can subscribe, I would really appreciate that as well. Okay, so let's get the U.S. legal disclaimer out of the way, and then we'll get started. So hang tight. Thank you.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and/or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
Okay, thanks for holding on with me. And so let's get started. I have a lot of positions, which I think is good from a teaching standpoint because I have a lot of positions with a lot of different strategies. You know, I trade about 7 different strategies. So I have a variety of every single one. Each one kind of has its own rules and so forth, but let's get started because there's a lot of them. And let's start with Netflix. So Netflix, I entered here on the 7th of August at $1,181 a share. So first of all, why did I enter Netflix? Well, this has to do with this green box here. This green box is called an order block. An order block is when you have somewhere in the past, you have a swing low, followed by a swing high, followed by a lower swing low, and then a move up that takes out that first swing high. When that happens, you have created an order block. And an order block is simply the lowest bar close before you change market structure to the upside. So when that happened here, this bar here is the lowest bar close. I took the high and the low, brought it out into the future, because in the future, these order blocks many times have support. If it had support back in the past before it changed market structure, more times than not, in the future, it will have support again. So again, I entered here on the 7th of August at $1,181 because the price, you can see the price prior, we went to the order block, then we lost the order block. But then we came back into the order block. So with order blocks, I can get in with the rejection of the high of the order block. I can get in with the rejection of moving averages or 30 RSIs inside the order block. Or conversely, I can get in if you're below the order block and then close back in the order block. So on this day here, 2 days ago, we closed below the order block. The next day we closed in the order block. That also would have been a legitimate entry. I didn't take it that day, but I decided to take it this day. 1, because we closed in the order block, and 2, because during the day we went below the order block and then closed back in it. So it retested it. It showed that there were not a lot of people willing to sell here. We ran out of sellers here. So that's why I bought it. So as soon as I enter, the first thing I do is I position size. I have to position size for the current volatility of the market and how much money I have in my account. So what I do is I take 1% of however much I have in my trading account. Let's say it's $100,000. I take 1% of that. If it was $1 million, it's 10,000. It's $50,000, it's 500, right? So $100,000 trading account, 1% is $1,000. I take that and divide that by the value of the 2 ATR. Right now, the value of the 2 ATR you can see up here is 53.62. So I take that, 1%, $100,000, $1,000 divided by the value of the 2 ATR. That shows me how many shares to buy. And what that does is that factors in the volatility of the market. That's in the reading of the 2 ATR. So by doing that simple math, now I just know how many shares to buy. So did that math, entered here 1181. Now the first thing I need to do as soon as I enter the trade is I need to place my emergency stop. And your emergency stop is just exactly what that 2 ATR is, right? So entered here, place my emergency stop 2 ATRs below. If it gets down there, now I have lost 1% of my account. But the good news is that only happens about 5% of the time. The other 95% of the time, if I have a losing trade, it will be because we close below my end of day stop. And the way I trade, my end of day stop is going to be always much closer to where I entered. So my end of day stop is just a close below this green order block, right here at about 1176. So I have a very good risk to reward ratio going into this trade. Worst case scenario, goes down here to my emergency stop, I lose 1% of my account. But more likely, if I have a losing trade, it will be because it just, closes somewhere below the low of the order block. So now that I've entered position size, I know where my emergency stop is, my end of bar stop is. Now what I do is I take my entry price plus the value of the 1.5 ATR, right? Right now, the 1.5 ATR here is $40.22. It changes every day, so it's a little different than what this is right now because this is for this day. But I took my entry price, I placed my 1.5 ATR trailing stop above me. And the reason I do that is if in the future I get to trailing stop level, now it's moved 1.5 ATRs from my entry. So now it's moved up pretty nicely. When that happens, I go into trailing stop mode. Trailing stop mode just means that if I now in the future have a close below a previous bar's low after reaching trailing stop level, now I am going to sell half of the remaining shares that I have. And so in trading, as we move up, you want to tighten your stops up. Well, by going into trailing stop mode and selling half of a position after you get to trailing stop mode, but then closes below previous bar's low, that tightens everything up. It essentially moves everything up twice, or by half, right? It just tightens it up. So everything I've talked about so far, the emergency stop, the end of bar stop, the going into trailing stop level, these are all considered to be defensive moves. Defensive in the fact that if something goes against me, I have to take action. If it goes to the emergency stop, I have to take defensive action. If it closes below my end of bar stop, I have to take defensive action. If I get to trailing stop level and then I have a close below previous bar's low, I have to take defensive action, right? So, but I don't always just want to be on the defensive. I also want to be on the offensive, just like in sports. You have to play offense and defense. So how do I do that? Well, the way that I play offense in trading is that I take a portion of my position off each day if it moves a certain amount each day from the previous bar's close. So I am currently in Netflix, and so exactly the way that I do this is this will be for Monday, well, for Tuesday, I guess. I just take the closing price of the day. Right now, the closing price is $12.0825. I take the closing price, $12.0825. I look for the value, the 0.45 ATR value, which now is $12.06. So all I do is I add the closing price plus $12.06. That gives me my first profit target. Now I take my first profit target, add $12.06 to it again. That gives me my second profit target for Tuesday. Take my second profit target, add $12.06 to it again. Now I have my third. So I always place 3 limit orders for the next day, exactly how I showed you, closing price plus the 0.45 ATR, and do it 3 times. Now the question is, how much do I get out of if I hit a profit target? Well, if I hit a profit target, I simply get out of 10% of however many shares I went into the day with. If I went into the day with 100 shares, then the first profit target I would place a limit order for 10 shares. Second profit, I would place a limit order for 10 shares, and the same with the third. Now, if the stock goes down the next day, I don't hit any profit targets. But if it goes up, maybe a little, maybe I hit one profit target, I take it off. I reduce my position size for the next day. Right now it's 10% of a lower amount for the next day. If I have a great day, I hit 2 profit targets. 2 profit target day is nice. Sometimes I hit 3. I've hit 7 before. But that's how I play offense. All right. So with all that being said, let's just kind of revisit again how I got into the trade, why I got into the trade, and see what happens. So again, I got in here on the 7th of August at 1181. I position size based upon my account value and the value of the 2 ATR. I placed my emergency stop 2 ATRs below. I placed my end of bar stop a close below the low of the order block. I placed my trailing stop level 1.5 ATRs above. And so the next day takes right off for me. Great day. Hit multiple profit targets, and I also got to trailing stop level. You can see, right? Got to the orange line. So now it's a great feeling being in trailing stop level. It really is. So now that I'm in trailing stop mode, it doesn't mean that I do anything necessarily. It just means that I'm in that mode. I am just waiting for a close below previous bar's low. So next day moves up again. Next day moves up again. I hit another profit target, so I'm settling into strength. The next day opens up nicely. And in fact, at the open, I hit another profit target, right? But look what happened at the end of the day. It had a reversal. And did this close below the previous bar's low? Yes, it did. Have we gotten to trailing stop level prior to that? Yes, we did. So what do? This is your first close below a previous bar's low after reaching trailing stop level. I took off half of the remaining shares that I had for a gain of 1.94%, right? Now I've tightened everything up because I've reduced everything by half. So the next day, off to the moon again. Am I bummed that I sold half here? No. That's the great thing about selling half. If you sell half and it goes down, you're glad you sold half. If you sell half and it goes up, you're glad you have half, right? One of the only true win-win things in trading is selling half. So it went up substantially. I hit multiple profit targets into that strength, which I was very happy for. And then the next 2 days, we kind of moved up a little bit, not enough. And then we had a big move down. Then we consolidated. Then here on this day, we moved up. I hit another profit target. And then here, Friday, down. So the remaining shares that I have on this particular trade currently up 2.26%. But it all started with this close back into the order block, giving me a very good risk to reward ratio. And again, I think this is a good example of playing offense and defense, taking partial profits off on the way up, tightening things up once we get to trailing stop level. Again, anytime we have a move up, take a little. And so ultimately here now, what happens? Well, if it continues up, I will continue to take partial profits. Right now, the RSI is 48.23. If I get to a 65 RSI reading, then I have other rules that come into place. Now the 5 EMA comes into place. If I get up to the 70 RSI, I also have exit rules there. If it goes down and closes below the low of the order block, well, I have to get out, right? That was my original end of bar stop from back here. So I have no idea what Netflix is going to do. But I do know exactly what I am going to do regardless of what Netflix does. And that's the key. You have to have a plan and you have to follow it. If I could control Netflix, I would. I'd make it go up for everybody. But I can't. So I have to know exactly what I'm going to do and whatever it does. If it goes racing up, I know what I'm going to do, take partial profits, so forth. If it goes racing down, I know where my stops are. If it moves sideways, Up some days, down some days, fine. I take partial profits. So, okay, so that's Netflix. Remaining shares on Netflix up 2.26%. Let's go to Adobe. Adobe, really nice trade. Like to thank my student Vivek up in Canada for the heads up on this trade. I was looking at Adobe to get long Adobe on the weekly, but he pointed this out on the daily, and I was like, oh yeah, you're right. That's a really good trade. So Vivek and I and some of my other students, we got long on the 12th of August at $336.07. Why? Well, this is an order block. You can see here's the green box from the past. Here is the trade. On this particular day, during the day, we were below the order block. And then we closed back in the order block. So that is a rejection of the bottom of the order block. That is a primary signal. Now, I use primary signals. I use secondary signals. This is a nice primary signal here. In addition to the rejection of the bottom of the order block, we also had a rejection under 30, over 30 on the RSI. This is a deep dip buy signal, also a primary signal. But you see how they happen together? Rejection of the bottom of the order block, primary signal, under 30, over 30, also a primary signal. Two primary signals, that's strong. But we also had secondary signals. This was on this day, it was a V1. A V1 consists of two bars, bar 1, bar 2. Bar 2 goes under bar 1's low, bar 2 closes above bar 1's close. Secondary signal, it adds bonus points to the trade. Lastly, this gray line here, this is the negative third ATR channel. 92% of prices tend to stop going down when you get to the negative third ATR channel, go sideways or go up. Well, on the day that I took the trade, we had closed back above the negative third ATR channel. So primary signal, rejection of the bottom of the order block. Primary signal, rejection of the 30 RSIs. Secondary signal, V1 entry. Secondary signal, rejection of the third ATR channel. I mean, you don't really get much better than that. I guess you can, technically, but that's a really good signal. So I got long 336.07. I position sized. I placed my emergency stop how far below my entry? That's right, 2 ATRs. Where is my end of bar stop? My end of bar stop is simply a close below the order block, which is not too far away. I placed my 1.5 ATR trailing stop level above, and off we go. Next day, immediately bounced from that signal, that's not surprising to me, hit multiple profit targets to the upside, also got into trailing stop mode. Great, I'm in trailing stop mode. Doesn't mean anything, it means that I am in trailing stop mode. Next day, nothing. Next day, up, profit target. Next day, up a little, not enough for a profit target. Next day, up again, profit target. Next day, we have our first close below a previous bar's low after reaching trailing stop level. What do? I take off half of the remaining shares that I have to tighten up all the stops. Took off half here for a gain of 4.86%. Next day down, no profit targets, and then right back up, multiple profit targets, which was great. Then kind of up a little, not enough for a profit target. And then we kind of moved down, no profit targets anywhere to be seen, but it's fine. Am I above the bottom of this green order block? I certainly am. RSI level right now is 49.58. If we get up to the 65 RSI level, then other rules come into play, right? But we're not there yet. So the remaining shares that I have on Adobe doing very well, up 5.74%. All right, let's go to LUV, Love, Southwest Airlines. Been a great trade. And this is a combination, essentially this is a combination of a deep dip buy along with a order block. So here we have this order block, the high and the low of the order block. And again, you have to go back into the past to find where this order block began all the way back here. 523.25. So it happened back in the spring of this year, but those order blocks tend to have memory. And on the 21st of August, two primary signals. During the day, we were in the order block, but then we closed above the order block. That's a rejection of the high of the order block. In addition to that, we had an intraday rejection of the 250 moving average, which is the purple line. So two primary signals, rejection of the high of the order block, and then the second is the intraday rejection of the 250. So it's an order block slash deep dip buy combination. So I got long here, 31.08. I position size. I placed my emergency stop 2 ATRs below. My end of bar stop, simply a close below that 250-day moving average, the purple line. You see how close I am to that already? That's the important part of trading, everybody. Being patient, waiting for your confluences, and making the determination, do I have a good risk to reward ratio based upon my end of bar stop? Yeah, super good risk to reward ratio. I'm so close to it already. If the next day it had simply closed below even a penny, I'd be out of the trade. That's it, right? So entered here, 31.08. I know where my emergency stop is, 2 ATRs below. My end of bar stop simply closed below the 250. I placed my 1.5 ATR trailing stop level above. Next day, boom, straight up. After that, really good combination of signals happens all the time, everyone. Not every time, but it happens so often, more than not. When you wait for these good, solid signals to take the trade, I'm never surprised the next day when it goes up a lot, because a lot of professional traders saw those signals, right? So next bar up big. I can't remember how many profit targets I hit. I think I hit 5 or 6. And now I'm in trailing stop level. But you see, I took off shares into that strength. So again, in next day, nothing, no profit targets, no nothing. Next day, up nicely again, multiple profit targets, right? Multiple profit targets. Let me check one thing, sorry. Yeah, I didn't think so. All right. Now, here on the 28th, we had our first close below previous bar's low. After reaching trailing stop level, what do? I need to take off half of the remaining shares that I have going to that day. And here, I took off half on Thursday for a gain of 5.53%. Right? Why? Because we had a close below a previous bar's low after reaching trailing stop low. So right now we're at 55.76 RSI. Again, if we go higher, I'll continue to take partial profits. If we get to the 65 RSI level, then new rules kick in. Specifically, if we have a close below the 5 EMA, that takes me out of the trade. If it gets up to the 70 RSI, now I have other rules that I have to follow at those elevated levels. So so that was there, and then it's going to be pretty much the same for here. So I took off half for a gain of 5.53%. Yeah, they're almost exactly the same. And the remaining shares up 5.53% based upon my quick little measurement that I did here. But really great trade, and just shows you, starting with a good risk to reward ratio, what can happen. All right, let's go to CRM. CRM has been a nice trade, and I was glad that I could take this trade because I wanted to show you and my students what a higher low V1 or V2 is. You know, I love these trades. They don't come along very often, but when they do, really, I just love them. So I entered here CRM on the 22nd of August at 247.90. Okay, why did I enter here? Well, let me first bring your attention to this green line and this green line. This is the 1 ATR channel. This is the negative 1 ATR channel. Anywhere below this green line and above this green line, anywhere in here is called the value zone. So this trade, the first requirement of this trade is you had to have closed below the low of the value zone. Well, clearly here we are below the low of the value zone. Over here too, right? So you first need to close below the value zone. Then you need to move back up into the value zone. And then once you're in the value zone, you have to have a pullback that is followed by a V1 or a V2. If you want to learn more about V1s, V2s, go to my YouTube channel. I have a video there that explains it in detail. But this is a V2. A V2 consists of 3 bars: bar 1, bar 2, bar 3. Bar 2 goes below bar 1's low. Bar 3 has to close above bar 1's close. Well, that happened. So we closed below the value zone. We came into the value zone. We pulled back and then had a V1 or a V2 that closed in the value zone. And the key part here, the reason it's called higher low V1, V2 is this low here higher than this low here? Yes, it is. New trends, uptrends, start to tend to happen with higher low closes, not lower lows. Lower lows do this. They go down, they bounce, pull back. Higher lows tend to trend up. So, and the nice thing about higher low V2 here is you always have a pretty good risk to reward ratio. So I entered here 247.90 on the higher low V2. As always, I place my emergency stop 2 ATRs below. Now on a higher low V1, V2, your end of bar stop is simply a close below halfway of the washout bar. Bar number 2 here is the washout bar because it washed out bar 1. Easy way to think of it is just take the bar after bar 1, that's your washout bar. So you have the high and you have the low. I'm going to pick right here halfway in the middle as my stop. There's some inherent support there from a Fibonacci standpoint. So got in, next day went up, or actually went down a little, no problem. Then we had this sell-off here. But did this take me out of the trade? Well, look, did it close above halfway? It did. Had it closed below, I would have gotten out, but it did not. That halfway level held, as it often does. Then next bar up, multiple profit targets. Thursday up, multiple profit targets, and then up again on Friday. And what happens on Friday? Look, I got to trailing stop level, which is 1.5 ATRs above my entry. So far this trade is doing very well, up 3.27% on the trade. Now, listen, here earnings are coming out on September 3rd. I will have to exit this trade before earnings because I do not hold through earnings. So regardless of where it is, if it's down, I get out. If it's up higher, I get out, but I never hold through earnings. So CRM up nicely, up 3.27%. MasterCard, or Microsoft, excuse me. Okay, interesting. I'm kind of glad this happened because it's a good teaching moment. So I got in here on Microsoft, an order block from the past, right? I got in here on the 21st of August at 5:04.11. Why did I get in here? Well, because this particular day, 1, we're inside an order block, and 2, during the day we went under the 50-day moving average, which is the gray line, and then we closed back above. Okay. My line in the sand now is if I have a close below the 50-day moving average. So the next day up nicely, hit multiple profit targets, which is nice. But then the next day, look what happened. It closed below the 50-day moving average. Well, that 50-day moving average is my line in the sand, right? What did I do? I had to get out of the trade because I'm in this trade above the 50-day moving average. I'm out of this trade below. Well, it just so happens that even though we closed below the 50-day moving average, it's exactly where I entered the trade. So it was a break-even trade. Actually, no, it was a profitable trade because I took some profits the next day on my 0.45 ATRs, right? So here I get out, basically on the bulk of it at break-even. However, the next day, here on the 26th, I re-entered. Why would I re-enter if I just got out? Well, I lost one level, but the next day I had another legitimate entry. What was the legitimate entry? It was a rejection of the bottom of the order block. You see how during the day we were below it, yet we recovered and closed back in it? Okay, that's the signal. So I entered here 502.10, position size correctly, place my emergency stop 2 ATRs below. My end of bar stop is simply any close below the order block. Remember, this order block is an important level. It should not close below there. If it does, I just need to get out, right? So took the trade, 502.50. Next day up, hit a profit target, right? Nice. Next day up, hit another profit target. Orange line up here is my 1.5 ATR trailing stop level. Have not got there, so a close below previous bar's low doesn't matter at this point. I would have to get there first. But it's a good example, everyone. If you take a trade and it fails, get out. But if you get another legitimate entry signal, don't be afraid to take it again. A lot of people go, oh, I just lost on Microsoft, or I don't want to take it again. If it's legitimate, don't let that happen. If you have another legitimate entry signal, even if it was after one where it didn't work, don't be afraid to take it if it's legitimate, right? So this one doing okay, nothing crazy, nothing too special, but not bad. And the remaining shares I have on Microsoft in 3 days up 0.92%. Okay, let's go to BA. Like to thank my student Stephen. He pointed this out, that he was looking at this, and I wasn't looking at it at the moment, but when I saw it, I was like, oh yeah, this is a good trade. So so far I have talked. So thank you very much, Stephen. Appreciate that. Had some good trades from my students lately. They've given me some good setups. So normally I talk about the bullish order block, which is green. Okay. Here we have a bearish order block, which is red. What makes a bearish order block? Well, it's the opposite of what makes a bullish order block. Bullish order block, we need a swing low, followed by a swing high, followed by a lower swing low, and a market structure change. Well, here we go. This is the opposite of this. We need a swing high, followed by a swing low, followed by a higher swing high, followed by market structure change to the downside. And when that happens, now I know where my bearish order block is. It's the highest up bar close before market structure change. Well, here you go. This is the highest up bar close, not the highest bar, but it's the highest closing bar. The high and the low of that out into the future becomes the resistance area. Well, look what happened a couple weeks ago. Once we got up to the resistance level, what happened? Yeah, we pulled back. Not surprising. Well, now we're up here again. Does it mean it has to go down from here? No, it doesn't, but it's more likely to. So I entered BA, and I believe Stephen did as well. I entered at 236.11 here. Why? Because we rejected the high of the bearish order block, right? You can see on this day the little wick, boom, poked its head outside above and then closed back below. So that's a rejection of the high of the order block. What does that wick really mean? It just means there's no more sellers up there. No more buyers up there, right? Every time it gets there, sellers overwhelm buyers. People aren't willing to buy there. So this is why I took the trade. So I got short at 236.11. I placed my emergency stop because I'm short 2 ATRs above. It's up there somewhere. Yeah. My end of bar stop is where? It is a close above the high of the order block. The high of the order block is 236.63. Remember, everything I do is based upon the closing price. It's the most legitimate price. So yesterday, the market down. During the day, Boeing was up. I was like, oh man, it's the worst, right? When you're short, the whole market's down except for your one stock. But it did turn around and did go back down. And so look where we closed. Yes, during the day we were above the order block. Had it closed up there, I would have had to get out. But it did reverse. And so far, so good. On this particular trade, on the short side, up what does that say? 0.91%. No, sorry, 0.61%. 0.61%. And you can see I have the orange line. It's down here, 1.5 below my entry. Why is it below? Because I'm short. If I get there, then I go into trailing stop mode. But good example of a short using a rejection of the high of the order block, up 0.61%. And again, Stephen, thank you for the heads up on that trade. So those are all the open positions that I have. Let's go now to the closed positions. Okay, so this is INDA. So I got long INDA on the 11th of August at 52.28. Why? Multiple reasons. Number one, we're inside a bullish order block. Number two, we went under 30, over 30. Okay, that's the signal. Number three, we had what is called a bullish abandoned baby. What in the heck is a bullish abandoned baby? Well, it's this pattern. When you gap down, do you see how this is the baby day here in the blue? The previous day we gapped down. Why do we gap down? Don't know. News was bad, sentiment was bad. But then the very next day, instead of continuing down, it gapped up. So we had a very quick change in sentiment. When you have a very quick change in sentiment, often that is a good entry point either to the upside or the downside. So we gap down followed by a gap up. So the signals here, one, we're in a bullish order block. Two, we have a bullish abandoned baby. Three, we go under 30, over 30. Okay, that's my entry. I am in at 52.28. I have my emergency stop 2 ATRs below. My end of bar stop is simply a close below the 30 RSI. Okay, next day, up. Great, profit target. Next day, up. Again, profit target. Then down, then up, profit target. Then big ups here, which clearly gets me above my trailing stop level. And again, I'm really glad that I took these partial profits when I have them, because look where it is now, right? So up, multiple profit targets, up again, Then here is our first close below a previous bar's low after reaching trailing stop level. I sold half of the remaining shares I had at that moment for a gain of 2.43%. The next day, big move up. During part of the day, what happened? I hit profit targets again. Look where we are now. Do you think I'm glad that I took those profit targets while I had them? Absolutely. Now, I told you that my initial end of bar stop was a close back below 30 RSI. Well, I do have one rule. If the primary reason that I entered the trade was an under 30 over 30, if I get to trailing stop level, if it ever comes back to break even, I exit the remaining shares. Well, I did worse than that because it gapped below break even. The previous day it was still above break even, so I kept the trade. But then we had the big gap down. So I had to get out regardless. So on the remaining shares that I had here, I took a loss of 0.58%. Not bad, but this is a good example of everyone. I think it's pretty clear. Trades like this can happen. And in this case, am I glad that I took profits when I had them? Am I glad I played offense and sold into the strength? Clearly. Am I glad I went into trailing stop mode and got out of half the position as per my plan here? Absolutely, because now we're down here. So I'm a big advocate of taking partial profits into strength. I'm a big advocate of when your position moves a certain amount from your entry to tighten up your stops. And again, the way that I do it, trailing stop mode, selling half. So I am out of this trade, the remaining shares down 0.58%. But again, really good example of why it's important to take profits when you do have them. All right. Last one on the daily is Alibaba. Now, this is a really, I'm glad I took this trade because it was profitable, and two, it's a good teaching lesson. So a minute ago, I talked about the bullish abandoned baby. Well, this is on Alibaba, BABA. This is a bearish baby here in the red bar. What makes this bearish? Well, look, overnight we gapped up. Man, everything's good. People are excited. Boom. The very next day, however, we gapped down. So again, very quick change in sentiment from bullish to bearish. When this happens on a bearish abandoned baby, the low of the baby, here's the baby in the red, the very low of the baby often acts as major resistance. So after the baby happens, if we rally back up and we reject the bottom of the baby, that for me is a very good short entry signal. And on this day, on the 25th, we rejected the bottom of the baby. Intraday, we were above it. End of day, we closed below it. That's your rejection. I got short here, 124.63. Okay. Now, when I enter abandoned babies, the way that I structure getting out and profit targets and everything is completely different. When I short an abandoned baby, the only plan that I have is I place a 2 ATR stop above me if I'm wrong, and I place a 4 ATR profit target below me if I'm right. Now, eventually one of these are going to hit, right? And if I'm right, I'm going to make twice as much as if I'm wrong. And statistically, taking these abandoned babies, the odds are significantly in my favor. So another way to put it is I'm much more likely to make 2 times what I'm risking, right? So if I'm risking 2 to make it, I'm risking 2 to make 4, but significantly the odds are in my favor that I'm going to make 4 instead of lose 2. That's a pretty good proposition. So I got short here, 124.63. Now, there's only one caveat in here, earnings, right? I don't hold through earnings. So when I got into this trade, I was like, okay, I'll get into trade regardless of where I am prior to the earnings. If I'm up, if I'm down, it doesn't matter. I will get out of the trade. And so earnings were Friday morning, I guess. So I got out Thursday night for a gain on the short, nice little gain, for a gain of 3.88%. But I am not going to hold through earnings. You never know what's going to happen. It's a gamble. So I got out, locked in my 3.88%. Look what happened on Friday. Am I glad I got out of my short? Oh, yeah. So it's just a good lesson, everybody. Holding through earnings, I mean, look, if you're a long-term investor, you got to do it. But if you are a swing trader, then holding through earnings is just a gamble. You never know what is going to happen. So anyway, it's a good story of getting out before earnings, locking in a nice 3.88% profit, and a good teaching moment to show you why holding through earnings really could go against you. So up 3.88%. Okay, so those are all the dailies, the open and the close. Let's quickly go to the weekly trades. Weekly trades close on Friday. So the weekly bar closes on Friday, so I make my decisions on Friday. So UUP, I got into UUP on the 11th of July. Why? I got in at 27.21. You can see here's the green order block on the weekly time frame. Here, the black line is the 200-day moving average. So the week that I got in here, the Friday that I got in here on the weekly bars had 2 primary signals. We had a close under, close over the 200-week moving average. That is a deep dip buy. That by itself is a legitimate primary signal. Also on that day, we closed above the high of the order block. That is a rejection of the order block. So 2 primary signals, close under, close over 200, and a rejection of the high of the order block. I got long at 27.21. I position size correctly. I placed my emergency stop 2 ATRs below. My end of bar stop is where? Just a weekly close below the 200-week moving average. As soon as I got in, I placed my trailing stop level 1.5 ATRs above. And next week, we went up, hit a profit target. Yay. Next week, we came back down, tested the 200, held it. Next week, up big. I hit multiple profit targets, and I also got to trailing stop level. Next week, nothing burger. Next week, closed below a previous bar's low after reaching trailing stop level. I did exit half the position for a gain of 0.51%. And the last 2 weeks, nothing really at all. This week it was up 1.5%. So the remaining shares that I have here up 0.62%, right? It's a currency. It's not going to move that much, but it's up, right? Again, next week, if we close below the 200-week moving average, simply out of the trade. If we keep going up, we continue to take partial profits. XLV. XLV has been a great trade on the weekly. It's a good teaching example of being very, very patient, waiting for the trade, waiting for the trade to come to the levels that you want. In a little bit, I'm going to show you the trades I'm looking at for next week. Same thing. I'm looking at the chart, waiting for the trade to come where I want. Well, this is a perfect example because I talked about XLV in this podcast for several months. I saw the bullish order block. I saw the 300-week moving average in the order block. As it was coming down, I kept saying on the podcast, I am waiting for some kind of rejection of the 300-day moving average in the order block. It got close, didn't get there, and then on the particular week that I bought it, it did. Look, it bounced at the 300-week moving average. It also rejected the high of the order block. I got long 130.07, position size correctly, placed my emergency stop 2 ATRs below my end of bar stop, simply a close below the 300-day moving average. I placed my 1.5 ATR trailing stop level above. Next week, took right off, like it often does. Hit multiple profit targets. Next week, up again for a profit target and also touch the trailing stop level. Now I am in trailing stop mode. Doesn't mean I do anything. It just means in the future, if I have a close below a previous bar's low, I will sell half. The remaining shares that I have on this particular trade up 5.4%. Okay, TLT. I've been in this trade for so long, everybody. It's one of these trades that has not gone up enough for me to get out. One of these trades that has not gone down enough for me to get out. So is there any advantage to that? Other than I'm tired of talking about this on this podcast. There is an advantage. TLT pays 4% a year dividend, and it pays it monthly. So as I've been waiting for it to do something, at least I've been getting a 4% dividend. All right, so let's be positive about it. TLT back here on the 17th of January, I've been in this trade. Why? Rejection of the high of the order block and a V1. Got long, 87.20. Emergency stop, 2 ATRs below. End of bar stop, close below the low of the order block. Placed my 1.5 ATR trailing stop level above. And nicely, we moved up week by week, little by little, little by little. Here, I hit a profit target, nothing. And then here, hit nice profit target and also got to trailing stop move, right? So I'm selling into this strength. A month of going sideways, doing nothing. Here on the 4th of April, nice big up, hit profit targets. And then the nice big up followed by a huge move down. It closed below a previous bar's low after reaching trailing stop level. I had to get out of half of the remaining shares for a loss of 0.58%. Then we had a few weeks up where I did hit a profit target. Then we had a month down. At this point, I was almost cheering for it to close below the low so I could get out, but it did not. The order block was too strong. And then we kind of drip our way up here. Nothing much. Down, nothing much. And that's pretty much what TLT's been doing. It has been respecting the bullish order block. And like I said, it's fine. It's 4%. I've made that for 8 months. Not bad. Not bad, right? And I did lock in profits when the market gave them to me. So we'll see what happens. You know, all this sideways motion is gearing up for either something to go up or down. Sideways motion leads to trends either up or down. We just don't know which way. But the remaining shares on this particular trade down 0.72%. And then last but not least, thankfully, is Amazon. A short on Amazon. I got short on Amazon on the 15th of August at 230.90. Why short? Well, you see the red box. Red box means that is a bearish order block. So as we rally back up into the bearish order block, I was keying off the bar here on the 7th of February. Why? It is a down bar. If you have a big down bar, if you rally back to halfway of that bar, you're going to have inherent resistance. In addition to that, that resides, this whole halfway down bar thing resides inside the bearish order block. So I was looking for a rejection of the halfway of the big down bar in the order block to the left, the one I just showed you, of 233.70. Well, on the week that I bought this on August 15th, it did touch that level and close below. So that is a rejection below. So I did get short here, 230.90. My emergency stop is 2 ATRs above. My trailing stop level is 1.5 ATRs below. And my end of bar stop is just simply a close above 233.70. See how close I am to that level already? So the next week it went down, and then this week it's been down. So it's not a big winner. It is up 0.77%, but it's just a good example of a structure, right? Waiting for it to come into a resistance level like the bearish order block, waiting for a rejection of the halfway. That happened. I can't predict what it's going to do, but I know exactly what I'm going to do. I have a very tight stop. If I'm wrong, I can be wrong small. If I'm right, I have a process that lets me make multiple times what I was risking to the upside. And that's what it's all about. So those are all the trades. I know when I'm doing my job in the podcast here, when I go through all the trades, did I have some really big wins? Yes, I did. Did I have some small, medium wins? Yes, I did. Did I have some break-even trades? Pretty close. Did I have some losing trades? Yes, I did, but they were small. Did I have any big losses? No, I did not. So in trading, obviously big wins are good. Small wins are okay. Break-even trades are okay. Small losses are okay, but you have to stay away from the big losing trades. And the other thing you're going to see, if I'm right on a trade, almost always, not always, but almost always, I will be in those trades for quite a long time. The trades that I'm wrong at, I'm wrong quickly. Just like the Microsoft trade. I was in for one day, out the next day, right? TLT, I've been in for 100 years, and it is down. So that's the one exception. But actually, all in all, I'm up because of the dividends, right? So be very impatient with your losers, super impatient, and be really patient with your winners, and get yourself a process that you can follow. I always talk about how important it is to follow your process. Well, first you have to get one, right? You can get one from me. I teach private lessons, teach a private course, and I'll talk about that a little bit more in a minute. But get yourself a process and then follow the process. So, okay, before we get on to the trades for next week, let us talk a little bit about trader psychology, okay? And then we'll get rolling on next week's trades. Okay, so this post is from my good friend Steve Burns. Steve is a great trader. He's a great author, one of the most prolific trading authors in the world, actually. I think he's written the second most amount of trading books, and I'm sure before he is done, he will be the #1 writer of trading books in the world. But you can check out all of his books at Amazon. Just type in Steve Burns Trading Books. You will find some really great books. My favorite, Moving Averages 101, and I was lucky enough to have the privilege to write the foreword to that book. You'll learn a lot from that book. So thank you, Steve. So let's see what Steve has to say here. Surround yourself with people that promote quantified data instead of emotions, personal beliefs, and opinions. Now, in general, everybody, this isn't just trading related, right? This is life related, But this is very specific to trading as well, and I'm sure that's why Steve wrote it. Surround yourself with people that promote quantified data with trading. What's quantified data? Well, that's technical analysis, right? If something rejects the 200-day moving average, if something rejects an order block, that is telling me there were no more sellers under that level. Therefore, it gives me an edge and a good risk to reward ratio to enter that trade. But what Steve is saying here, I think what Steve's saying here, that's how I'm reading it, is that, because I teach trading, because I know many traders around the world, all sorts of different traders, really on a huge spectrum. And in my experience in 30 years of trading, the ones that are profitable consistently, make a living at trading, they are basing their trading off of quantified data. Or in other words, you could say based on good technical setups, right? Like the ones that I use and the ones that I teach. You have other people in trading that base things off of emotions, personal beliefs, opinions. Market's too high, it can't go any higher. Market's too low, it can't go any lower. So-and-so earnings got to be really good. So-and-so earnings got to be really bad. Listen, I deal with this stuff all of the time. And just truth be told, the ones that are emotional and have these personal beliefs and opinions have the worst results. Every time. Rarely is there an exception. Every once in a while there'll be an exception. See, I knew it. I knew it. Yeah, you knew it 1 out of 11 times. That's not going to get it done. So I'm just trying to tell you, if you want to be a profitable trader, you want to be a long-term profitable trader, right? Is what they call them. You've got to get yourself a process. You've got to get a process that you follow. And stay away from traders, families, whatever, that promote emotional decisions in trading, promote their personal beliefs on what they think the market has to do or not do, and their opinions of the market, or what this economic report is going to be. Just don't do it. Don't go there. Just, you can learn it from the school of hard knocks and just do it and learn it and go, oh, yeah, Greg was right. Or you can just believe me and don't do it. Base your trades on something quantifiable with a good trade structure, so you know when you stay in the trade and you know when you stay out of the trade. But stay away from stories, emotions, beliefs, biases. All right? So anyway, I hope that was helpful. All right, let us now talk about potential trades for next week. Let's do that. Okay, so here I have for this is on the daily. I have 11 potential setups for next week. Now, is it possible that all 11 of these could trigger on the daily time frame at the same time? Yeah, 100% it is. Does that mean I would take all 11 positions? Absolutely not. I only take one position per day. I take the best position of the day. Even if 11 of them trigger, I'm going to narrow it down to one. There is going to be one that's better than the other 10. I take into account how many signals there are, what the risk to reward ratio is, what things look like on higher time frames, what the relative strength of that particular stock is to the rest of the market, right? I give it a scorecard. And the one with the best scorecard is the winner of the day, and that's the one that I take. And this is what I teach in my private one-on-one lessons. And listen, I teach a really good course. I teach a 20-hour course. And I've been teaching for many years. I've taught traders from all over the world, from absolute beginners all the way up to the hedge fund level and everywhere in between. And listen, I'll tell you, to learn to trade, it seems kind of easy on the surface, but there are a lot of nuances that go into it. And I am convinced now, after all these years of trading, the only way to properly teach a student is with many hours of trading, with many different conditions in the market. And I think the very best way to learn trading is one-on-one. And it's important to have a coach. Listen, I play baseball every day. I learn from YouTube, but I still have a coach. I went to my coach last week, and the things he told me that I don't see because I don't see myself play were really helpful. But every professional athlete has a coach, right? Well, in trading, you should have a coach. You should have a mentor that knows how to trade and can teach you the proper way. So, like I said, I have a 20-hour course. Each session is 2 hours now, and we do 10 of those. And if you become my student, I will teach you everything that I know. And when you're done, you will have a very good skill that you can use the rest of your life. So my email is in the link of this YouTube video. Just send me an email. We can get this. We can get the process started. Generally, what I do is I just have a get to know you call with a prospective student. It's not a sales call. It's just a call to, for them to ask me questions about the course, me ask them questions about their experience and their goals. And then when we're done with that call, that's it. If the student is interested, they'll have to contact me back and we can get started. But I know you will be happy that you took this course because I've taught so many people around the world, and they really are. So yeah, send me an email. We can get the process started. As a alternative, I do have a really good online course available at udemy.com where I teach you the deep dip buy setup. It's 9.5 hours of instruction in video. It's a really great course. I've sold so many of those around the world, and I think it's 4.8 out of 5 stars on that course, and that's very, very affordable. Obviously, the one-on-one is more expensive, but you get a lot more, and you get me for 20 hours. That's a deal, right? So anyway, that's my plug for the day, but if I can help you with your trading, help you find a process, be glad to just send me an email. So let's start here on AMD. Now again, I have 11 potential trades here, or setups for next week. Maybe none of them get to where I need it to. And if none of them get there, what do? I don't do anything, right? I don't do anything unless I get a trade. If I get multiples, then that's what I was just telling you before. I have to narrow it down. But let's start with AMD. This one's fairly close. You can see here I have a green order block. Why the order block? This is the order block. Why is this the order block? Because we have a swing. Prior to that, we have a swing low. We have a swing high. We have a lower swing low. We change market to the upside when that happens. Now I know the high and the low, the slowest bar close is the bounceable area. Bring that into the future. Well, we're in the order block right now, right? Does that mean I buy? No. If I rejected the high of the order block, okay, that's legit. It's kind of a wide order block, so I want a better risk to reward ratio. Well, look at the 50-day moving average. This is the line down here. This is the gray line. This is what I'm looking for next week. I'm looking for a rejection of that line, either a bounce at that line or an intraday rejection of that line or a close under and then close back over that line. Now I have a line in the sand that I can key the trade off of. If it's above the 50, if I take the trade and it's above the 50, I stay in. If it's below the 50, I get out. Now, the second alternative, if it just melts through the 50 and rejects the bottom of the order block, then yeah, I could take the trade at the bottom with the rejection at the bottom of the order block as well. But, this stock has moved up significantly. So a pullback to the 50-day moving average, the gray line, is not surprising, right? It happens. But the advantage for me is that you have that moving average inside the bullish order block. So just simply, I'm waiting for rejection of that 50-day moving average and or a rejection of the bottom of the order block on AMD. Caterpillar, very similar to AMD. Here's our order block in the green. Here's our 50-day moving average in the green. Same thing. I am waiting for a move down rejection of the 50-day moving average in the order block. Look up here, red order block. What's a red order block? That means it's resistance more likely to go down. Was it right? I'd say, right? Soon as we came back into the bearish order block, boom, down. But now we're in the bullish order block, right? This is the bounceable area. But for me, I want a rejection of the 50-day moving average for my entry. Etsy. Man, everybody just couldn't get enough Etsy up here. Just had to have it up there. I never buy up here, folks. And in my lessons, I teach my students not to do that either. And imagine, oh my gosh, I got to own Etsy here, and now this happens. Okay, so I am looking for, you can see the green box. This is the order block. It's still not there. But you might say, Greg, I don't see any 200-day moving averages or moving averages inside that order block. And you are correct. There is not. But you know what there is going to be in that order block? A potential under 30, over 30 RSI. Right now we're at 34.96 RSI. So next week, if we come down further into this order block, it's very likely that we could bounce at the 30 RSI or go under and over 30 RSI. It's a legit signal. That is a deep dip buy signal. But when deep dip buy signals happen in order blocks, it makes them much stronger signals. So really, that's what I'm looking for. Now, you could say, well, it's a 200-day moving average right now. What about if it closes above it? Yeah, legitimate, but I'm not interested in Etsy unless I'm just going to be really picky, right? I'm just not interested in Etsy right now unless we get into the order block and go under 30, over 30. If we do, it's probably a pretty high probability trade. And so that's what I'm looking for. IBB. Okay, I don't talk about this a lot because it doesn't happen a lot lately, but I want to point out two lines to you. The black line, which is the 200-day moving average, and the 50-day moving average, which is the gray line. Okay, so you can see that the 50 crossed the 200-day moving average. You've probably heard of this. This is called the golden cross. When the 50 crosses over the 200, long term, that is a long-term bullish signal. However, what I have noticed in my 30 years of trading is when that golden cross happens, many times you initially pull back. Just a strange thing, but it happens. But what I have noticed is when you have a golden cross and you pull back, when you pull back to the 200 after the golden cross, right? Gray crossed over black. If and when you pull back to the 200 after the golden cross, usually more times than not, you get quite a bounce there. That's a strong signal. So right now, the order block on top of all this order block has the 200-day moving average in it. So if it comes down, I don't know if it's going to or not, but if it does next week or the week after that, if it comes down and rejects the 200-day moving average, not only you're rejecting the 200-day moving average inside the order block, but you also have the added variable of that you had the golden cross prior to that. And anytime you buy a pullback to the 200 after the golden cross has happened, there's an edge in that trade. But here you have an even bigger edge. You have a golden cross, pull back to the 200 after the golden cross, and that golden cross 200 just happens to live inside the order block. That's a strong signal, but obviously we are quite a long ways from that. So it's unlikely that it'll happen next week. It's possible, but if it does, that's what I'll be looking for, or in the weeks in the future, right? It may take 2, 3, 4 weeks for that to happen, but I'm identifying it early so I can track it. IBM, probably my favorite setup, but it's just not there yet. IBM has had a significant sell-off. Everybody had to have it, and then now nobody wants it. Well, there's an extremely strong signal here. You see the order block. The order block stems all the way back here from 424.25. So back in April, this order block formed. And let me put it to you this way. Here, when we were at the high, and you look back at this order block, could you logically say, oh, there's probably some pretty smart money buying in this order block now that 3 months later we're this far extended? Yeah, I mean, I think that's pretty fair to say. When you're way up here, you can go, oh yeah, in hindsight, smart people were buying that money or were buying this level. Well, look, this level going into the future, we're getting pretty close to that level again, to that smart money level. Does it mean it's going to be smart money this time? Not necessarily, but it's probably more like, if it was smart money back then, it's probably more likely that it's smart money now. Not for sure, but more likely. Okay? Like we deal in likelihoods, right? So what I'm waiting for is a rejection of that 300-day moving average inside the bullish order block. Now, depending on how long it takes to get there, if in fact it ever gets there, by the time you got down here, you may be in the low 30 RSIs. You're at the negative third ATR channel. There are lots and lots and lots of support levels here at about 230, but that's still $13 below us. So this may not happen for me next week, may not happen the week after, may not ever happen. But if it does, and I get a rejection of that 300-day moving average, that is where I would enter the trade. INDA. Okay, so I had to get out of INDA on Friday, but I'm ready to get back in INDA. Why? Well, for one, we are in the order block. Okay, that's one. Secondly, let's take a look at the low here. Look at the lows here. Look how deep the red MACD bars are. These are momentum indicators. Pretty deep. Well, after they were deep, they went up, and now we have green. Are we lower here now than over here? Of course we are. Does the depth of the MACD, is it low or lower than over here? No, it is not. You barely have any red. This is called a double bottom with the bullish MACD divergence. I learned this from studying one-on-one with Dr. Alexander Elder. All this means is, even though you have a big move down, from a MACD perspective, the momentum on this leg down was less than this. And the implication of that is that you are running out of sellers. And if you're running out of sellers, most likely you're going to go back up. All right. This is what people who trade double bottom bullish divergence, this is how they look at the market. So this is happening. From a MACD perspective, it's undeniable. The downward momentum is getting less and less and less, which means you're running out of sellers. If you run out of sellers, you go up. All right. So we have a double bottom bullish MACD divergence. By the way, I teach my students this in my one-on-one course, the double bottom bullish divergence and ATR divergences and RSI divergences. But so contextually, big picture, I like this. I like the double bottom bullish divergence, but I still need another signal to get in. What would that be? Well, one option is we go under 30 over 30. That's another option. Another option, we gap up and we have a bullish band of baby, right? So I don't know what it's going to be. I just know big picture, I like, even though I got out on Friday, I am looking to re-enter because I know big picture things look bullish, even though it looks very bearish, right? So I just need a signal, under 30, over 30, bullish abandoned baby, something like that. So that's what I'm going to be looking for. But the purposes of this right here, I'm just going to say under 30 over 30 or a bullish bandit baby. Coca-Cola. Okay, so Coke, you can see the big green order block. Now, can I take a rejection of the high of the order block? I could if the order block was narrow, but this is a big wide order block, so I'm not messing with that. So really what I'm looking for on Coca-Cola, three different levels here. We have three major moving averages. We have the 250-day moving average, which is the purple. We have the black moving average, which is the 200, and we have the orange, which is the 300. These are all major moving averages inside a bullish order block. So if I get a rejection of the 250, I could potentially take the trade. If I get a rejection of the 200, I could potentially take the trade. If I get a rejection of the 300, I could potentially take the trade. So, this one very likely could happen next week. And so that's what I'm looking for. Rejection of one of these major moving averages inside this bullish order block. If it rejects it and I take it, then that moving average just becomes my line in the sand. If it stays above, I stay in. If it goes below, I get out. It's that simple. NVIDIA. Okay, so NVIDIA is interesting. Look, we've had a huge run on NVIDIA. Is a pullback to the 50-day moving average, going to be surprising to anybody? Not me, because it happens all the time. Now, look, we're not near the 200 or the 250 or the 300, but we have had this kind of a pullback, right, on this high flyer. Well, we have an order block here. The high and the low of the order block starts here on the 22nd. And we go into the future. You can see the first time we came into the order block, this is where it bounced. But what I'm keying off of and looking for NVIDIA is simply a rejection of this 50-day moving average. If we reject the high of the order block, I could potentially take that trade as well, but I would not put my stop all the way at the bottom of the order block. It would be the 50. So Tuesday, if we reject the high of the order block, yeah, I could potentially trade it and enter, but my stop would be a close below the 50-day moving average. Or if it just comes through into the order block, rejects the 50, that's my line in the sand, right? I could take the trade there because it's a rejection of the 50 inside the bullish order block. Next day, if it closes below under 50, I'm just out. If it goes lower, then I could get in at the bottom of the order block as well. But that's what I'm looking for right now, is a rejection of that 50-day moving average, a bounce, a rejection, close under, close over on NVIDIA inside that bullish order block. Pfizer. Okay, so here we have an order block all the way down here in the green. It started on the 31st of August or July. We have a nice 200 or 100-day moving average inside of that order block. That is where I would look for a key off of rejection of that 100. But remember how I just told you about the 50 crossing over the 200? Well, look here. The 50-day moving average crossed over the 200. And what did I say? When you have a golden cross, usually, ironically, you get a pullback. Well, it's exactly what's happening. And I also said that the first rejection of the 200 after the golden cross happens is generally a high probability trade. So I have two levels to look at on Pfizer. If we come down and reject the 200-day moving average, I could take it even though it's not in an order block because of the previous golden cross. So that's one option. Then use that 200 as my line in the sand. The other option, it comes into the order block and rejects the 100-day moving average. Now, maybe neither of these happen. That's fine. Then I just move on to another trade. But again, this is what I do on the weekend. I look at these things and go, okay, now I know. Next week, I don't have to scramble and, I need to find a trade or whatever. That's why I do it on the weekends, and that's what I would suggest to you. Identify these things on the weekends so that during the week, when it's crazy, you already have things laid out. So two options: rejection of the 200 because of the previous golden cross, or if it goes lower, rejection of the 100 inside of the order block. Tesla. Okay, Tesla has an order block here. Swing low, swing high, lower, swing low. Market structure change. Lowest closing bar is right here. What lives inside that order block? 50-day moving average. There's 200 above. Could you take that? You could. I'm not going to. I am only waiting for, or if it comes down into the bullish order block, rejects that 50, then that 50 is my line in the sand. Walmart. One of my other favorite trades here, everybody. Is it going to get there? I don't know. Where's there? Look, 200-day moving average inside of the bullish order block. What is that at? That's at 94.25. Right now we're at 96.98. Is it possible? Of course it's possible. Right? So could I take a rejection of the high of the order block? I could. The order block's not that wide, but at the moment, I don't want to. At the moment, I want what I want. Right? I want a rejection of the 200-day moving average inside that order block. And I wouldn't be surprised if it gets there. Sometimes that 200 is like a magnet. So that would be a very high quality trade on high quality stock that's sold off significantly. And again, look, order block up here, red, telling you very likely you're going down. As soon as it got into red, it went down, right? It was right. But again, this is about patience. This is about patience of waiting for a move back down to reject the 200-day in the bullish order block, and then I would consider taking the trade. All right, those are the dailies. Let's do the weeklies, and then we'll be done. Philip Morris on the weekly. Again, these are weekly bars. Nice bullish order block on the weekly bars. Nice 50-day moving average and negative third ATR channel kissing right there together. That's even better. Are we going to get there? I have no idea. But next Friday, if we have come down and reject that 50-week moving average in that negative third ATR channel, I certainly would consider taking the trade. My line in the sand is that 50-week moving average. If it stays above, I stay in. If it closes below, I get out. Tesla. Okay, well, I just showed you Tesla on the daily at this closer order block on the daily, but let's go to the weekly. And I've talked about this for months. It's just not there yet. But I have to be prepared for the fact that if it does get there, I already know in advance that I want to maybe buy it. On the weekly, we had this beautiful order block, and we have the 200-day moving average inside the order block. So a 200-week moving average inside the order block. Below it's the 250, below it's the 300. So very unlikely it's going to get here, but if it does, that would be the place that I want to buy it. So on the weeklies, if, maybe not next week, maybe not in 2 weeks, maybe in 3 months, if we get down here, reject the 200-week moving average, 250 or 300, I would consider taking the trade. And then lastly, Verizon. Haven't talked about Verizon for a minute, but it's a nice little trade. We have an order block. Why isn't it an order block? We have a swing low, followed by a swing high, followed by a lower swing low, followed by a market structure change. As soon as you change market structure to the upside, I want to look to buy a dip back to the bullish order block. Well, I know where the bullish order block is, and does anything live inside that bullish order block? Yes, 50-week moving average. So I'm waiting for a pullback. May not happen this week, may not happen for a month, but eventually if it does pull back and reject that 50-week moving average inside that bullish order block, to me, that's a good risk to reward ratio. There's an edge in that trade, and I would consider taking it. So, boy, this has gone on a long time today. I had so many positions, but I hope you found it helpful, everyone. If you did, I really would appreciate if you hit the thumbs up button. If you are interested in studying with me one-on-one in my 20-hour course, just send me an email. I would love to have you as a student. I'll teach you everything that I know. If you have any comments or questions about this podcast, please put them in the comment section. I'll do my best to reply to you. I hope you have a really good weekend. If you could find it in your heart to try to do one nice thing for a human each day, it would just make the world a better place. If you could find it in your heart to do one nice thing for an animal each day, it would also make the world a better place. Animals appreciate acts of kindness just like we do. So God willing, I will see you next week. Again, if you have any comments, questions, anything I can help you with, send me or put them in the comment section. I'll do my best to get back. And if I can help you personally with your trading, just send me an email. All right, everybody. Thank you so much. Enjoy your long weekend. Be good, be safe, and we'll talk to you hopefully next week. Take care, everyone. Bye-bye.
U.S. government required disclaimer. Stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.